Trading. It's a battlefield, and every trader who enters this space carries with them a mission to conquer. But for many, it's not the market that's the toughest adversary, it's themselves. We're told time and time again,
trading is 90% psychology and 10% technicals.
You need to fix your psychology.
Work on your mindset.
but are we really addressing the root of the problem? They say trading is 90% psychology and 10% technicals. But what if we've got it all wrong? What if the problem isn't our mind but the system we're using? In this video, we're going to break down why psychology isn't the root cause, what actually causes most trading struggles, and how to build a strategy that works with your psychology and not against it. By the end of this video, you'll see trading psychology in a completely different way. I'm Vikas Kulkarni from House of Trading, and let's get started. The real reason trading feels hard, your strategy isn't designed for you. A system that forces you into emotional swings, random trades, or uncomfortable hold times won't be fixed by a pep talk or a self-help book. No matter how much you tell yourself to think positive, it's not going to change the reality of the market. Would you feel comfortable taking a trade where your stop loss is 3 times your average loss? What about risking 4% of capital just to chase a 1% return? No one would. A good strategy should make trading feel easy, repeatable, and stress-free. If it doesn't, the issue isn't your psychology, it's your approach. So before we talk about psychology, let's first understand why traders actually struggle and how to fix it. The two biggest trading psychology killers: financial pressure and external stress. Trading under financial pressure can cloud your judgment and lead to poor decisions. When trading is your sole income, you're likely to overtrade to recover losses, hold on to losing positions too long because you can't afford to take a loss, and panic when the market moves against you. This only escalates emotional decisions and leads to bigger mistakes. The solution is to always have a secondary income source until your trading is consistently profitable. Trade with money you can afford to lose and take your time building consistency. Most successful traders start part-time, gain confidence, and then transition to a full-time role once their numbers are reliable. And the second mistake is chasing big gains instead of building capital. Chasing unrealistic goals like making 10% per month or doubling your capital in the next 6 months is a fast track to disappointment. If you had rupees 30 lakhs, you wouldn't need to take big risks to grow your capital. Instead, you would focus on modest but consistent returns and compound them over time. The key is consistent growth, not wild bets. Aim for steady returns like 3 to 4% per month and scale your strategy over time. Professional traders focus on risk management first and growth second, gradually compounding their capital to achieve long-term success. Now, let's get into the power of data. The biggest thing that separates successful traders from those who struggle with psychology is knowing their numbers or their stats. When you understand the numbers behind your strategy, you take emotions out of the equation. Emotions tend to spike when we don't know what to expect. Losing streaks feel much worse when we have no idea if they're normal, and sudden volatility can make us panic if we are not prepared. That's where the Monte Carlo simulation comes into play. It helps in simulating thousands of possible outcomes to show you the range of results your strategy could experience over time based on real-world randomness. Let me show you how this works with my own trading performance. The starting capital in this case is rupees 10 lakhs and the risk per trade is 2%. This means you're risking 20,000 rupees per trade, and the hit rate or the win rate is 65%, which means you win 65% of the time. And there is a break-even rate of 3%. Number of trades per month is 20, and the risk to reward ratio is 1.6. For every 1 rupees you risk, you aim to make 1.6 rupees. We'll simulate this data for 3 years or 36 months to see what happens over time. Here's what you'll see. The green line. The green line represents the best case scenario. Everything goes in your favor and your strategy works at its highest potential. The blue line is the median case, the most likely scenario factoring in both wins and losses. The red line shows the worst case scenario, accounting for down periods, losing streak, and natural drawdowns that happen in real world trading. Why this is so important? Once you've simulated your data, you can approach trading with a clear mindset. Let's say your simulation shows that on average, you'll experience a 10-day drawdown every 6 months. When that drawdown happens, you're mentally prepared. You won't start second guessing your strategy or feel the urge to take unnecessary risks just to make up for the losses. It also shows you the true potential of your strategy. Instead of focusing on a single winning trade or a losing streak, you can think in terms of long-term probabilities. If your strategy shows consistent growth in the simulation, even with drawdowns, you know it works. Let's recap everything we covered today. First, stop trading out of desperation. Make sure you have another source of income. Second, stop chasing every new strategy. Instead, pick one high probability setup and master it. Finally, stop taking high risk trade. Focus on building a system that can actually scale over time instead of making random bets. And most importantly, start tracking your stats. Backtest your strategy, analyze your results, and remove emotions from your trading decisions. Most traders don't have psychology problems. They have strategy problems. And once you fix your system, your psychology will fix itself. Now, I'd love to hear from you which part of this video resonated with you the most. Drop a comment below and let me know. And hey, if you found this video helpful, make sure to like, subscribe, and turn on notification so you don't miss out on the next video. I'll see you in the next video.